How are you viewing the market action that we're seeing today after those huge rallies over the last 2 days, I should say?
Well, I look at this in terms of just what is our outlook for, the next couple of quarters, but really what's our outlook for the next month? And, if we go back to Thursday or Friday of last week and you would ask me how I felt about the next 4 to 5 weeks, I would have been somewhat concerned. We're entering into an earnings season that we could continue to see guidance downward. That's what everybody is concerned about from a multiple perspective, is that we're not only have seen multiple compression this year, but we're also going to start to see earnings come down very markedly from an estimate perspective for 2023. So as we go into earnings season, we're also having the culmination of the midterm elections. That could be a positive on the other side of the election. But right now, to Jim's point, we're pending a CPI report. We're pending the beginning of earnings season. We're seeing, some, I would say, mixed data in terms of job openings this week, as well as your announcement that came on Tech Check of jobs being cut from an Amazon perspective in terms of openings. So I think we have a very mixed story over the next couple of weeks. What I start to get optimistic about, or what I start to look at, is how does that set us up for the end of the year? And is this reallocation that we've seen, are there going to be opportunities to potentially look at industries and sectors that do have a fundamental tailwind for next year, despite the fact that they're not going to receive a strong secular tailwind into next year? And so, I'm still cautious over the next couple of weeks. I think we're going to continue to see volatility. We're seeing big macro moves one way or the other. That's why you're seeing the percentage of stocks that are moving in the S&P 500 be very significant, because these are macro trends. And until we get some clarity around inflation and start to see that real improvement and sort of get past this end of October tipping point, I think we're going to be in the market very volatile over the course of the next couple of weeks.
So, Joe, we're looking for some clarity on CPI and a whole host of other things. We did get some clarity on the oil market today. OPEC making that major cut, 2 million barrels per day. We're going to talk energy more later in the show, but how are you seeing the market? I would think that cut would be inflationary unto itself.
From a longer-term perspective, energy and healthcare are two sectors that still make sense for investors to carry at an overweight, given the overall environment that both Shannon and Jimmy described. We're going to come through a very difficult earnings season. I don't think you're going to get any degree of full certainty on whether this was the ultimate low for the market that we experienced last week. In the interim, what you're witnessing right now really relates to a reaction to where the U.S. dollar is pricing, where Treasury yields are going. We have the perception that on last Wednesday, we had a peak for the U.S. dollar. Therefore, subsequent to that, a lot of the areas in the equity market where there was a significant short interest being maintained, whether that was in the chemical names, the steel names, the gold names, the industrial names, overall materials themselves, you saw a significant unwind. You saw it in the Russell outperforming over the last 2 days, the S&P 500. The Russell was up a little bit less than 7%, while the S&P was up around 5.7%. So this has not really been about Apple or Microsoft or technology recovering, which a lot of the rallies in the past have been about. This has been a reaction to a potential peak in the U.S. dollar. I would caution everyone that we did the same thing in early September, heading into an inflation report. We unwound the bearish positioning. We're doing it again right now, but we're doing it a little bit differently this time, Frank. We're doing it in the places of the market that have that correlation to the dollar. And if you're looking for any degree of trading opportunity, I would guide investors in that direction.
Speaking of opportunities with the dollar, I know you just recently bought Freeport-McMoRan. We were just showing the chart a second ago. The dollar up almost 1.5% today, but actually down 1% over the last week. So obviously that rise of dollars put a lot of pressure on a lot of companies. What made you want to buy Freeport-McMoRan with the dollar declining briefly? Obviously today's an exception.
Well, it's a reaction to the overall market rallying over the course of 2 days, 5.7%. We all know the statistics on the infrequency of doing that in a very short period of time. So I wanted to do something, accept risk into the portfolio in response to that. Initially, I was looking into doing it in some of the mega cap technology or consumer discretionary names, or maybe technology overall itself. But I really thought the proper way to add that risk was to do it with a correlation to the U.S. dollar, a U.S. dollar which has risen nearly 17% year to date. So in the interim, while we wait for further clarity on earnings and what the Federal Reserve is going to do, I really think everything is going to be that reaction to the U.S. dollar. And Freeport-McMoRan commodities themselves have been responding to the lower dollar. Freeport-McMoRan, a great example of that. And I really think you could look at multinational companies universally here as a potential trade opportunity if we are going to see last Wednesday be the peak near term for the U.S. dollar.